Welcome, everyone. Today, we are diving into what is called the order book in the stock market. We are going to explore what the order book is and how it actually works. By the end of this discussion, you will have a solid understanding of how it helps traders make sense of what is going on behind the scenes in the stock market. We are going to keep things clear and simple, so do not worry if you are new to this topic. Let us get into it. Imagine having the ability to look into the heart of the market and see what every buyer and seller is planning. That is exactly what the order book offers. So, what is an order book? Picture a list that updates in real time, showing all the buy and sell orders for a particular stock. It shows both the price and the quantity that people are willing to trade. The order book is like a window that lets you see where the supply and demand are sitting for a stock. This can help you figure out where the buyers and sellers are positioned and predict where prices might move next. Now, beyond just understanding the order book, it is also helpful to recognize common chart patterns that often accompany price movements. These patterns can give traders additional clues about what might happen next. Let us go through some of these patterns in more detail so you can understand what they represent and how they can be used to predict future price movements. One of the most well-known chart patterns is the head and shoulders pattern. This pattern typically signals a reversal in the current trend. The pattern is named for its shape, which looks like a head with two shoulders on either side. When the price forms this pattern, it usually indicates that a stock is about to change direction, either from an uptrend to a downtrend or vice versa. Spotting this pattern early can help you prepare for a potential reversal and time your trades accordingly. Another important chart pattern is the double top or double bottom. A double top forms when the price reaches a high point, pulls back, and then tries to retest that high but fails, forming two peaks at roughly the same level. This usually signals that the price may be ready to move lower. A double bottom, on the other hand, forms when the price hits a low point twice, indicating strong support. This pattern suggests that the price may be ready to move higher. Recognizing double tops and bottoms can help you identify key support and resistance levels in the market. Triangles are another common chart pattern that traders look for. There are three main types: ascending, descending, and symmetrical triangles. An ascending triangle forms when there is a horizontal resistance line with rising lows, indicating that buyers are gradually pushing the price higher. A descending triangle forms with a horizontal support line and falling highs, signaling increased selling pressure. Symmetrical triangles form when both the highs and lows are converging, indicating that a breakout could happen in either direction. Triangles are typically continuation patterns, meaning that the price is likely to continue in the same direction once it breaks out of the triangle. Flags and pennants are short-term continuation patterns that often follow a strong price movement. A flag forms when the price moves sharply in one direction, followed by a period of consolidation that resembles a small rectangle or flag. This pattern suggests that the price is likely to continue in the same direction once the consolidation is over. Pennants are similar but are shaped like small triangles. Both patterns indicate that the current trend is taking a brief pause before continuing, and they can help you decide when to enter a trade in the direction of the prevailing trend. Wedges are another chart pattern that can indicate a reversal. There are two types of wedges: rising wedges and falling wedges. A rising wedge forms when the price is making higher highs and higher lows, but the range is getting narrower. This pattern often signals a bearish reversal, meaning the price may drop. A falling wedge, on the other hand, forms when the price is making lower highs and lower lows, but the range is narrowing. This is often a bullish signal, indicating that the price could move higher. Identifying wedges can be very useful in predicting trend reversals. By learning to spot these patterns, you can combine the insights from the order book with technical analysis to make more informed trading decisions. Each of these patterns tells a story about the battle between buyers and sellers, and recognizing them can give you an edge in understanding where the market might be headed. Pretty cool, right? The order book is structured in a way that makes it easy to see what buyers and sellers are up to. On one side, you will find the buy orders. These are often called bids. The bids show what buyers are willing to pay for the stock and how much they want to buy. On the other side, you will find the sell orders. These are often called asks. The asks show what prices sellers are willing to accept and how many shares they are selling. Now, something really important is that the order book does not just show the current best price for buying or selling. Instead, it lists multiple price levels. This means you get a deeper view of the market, which is super useful when you want to understand how much interest there is at different prices. Let us touch on a few key concepts that will help you better understand how the order book works. The first one is the bid-ask spread. This is just the difference between the highest bid price and the lowest ask price. When this spread is small, it means the stock is easier to trade because there are a lot of buyers and sellers close to the current price. A narrow spread means that the stock has high liquidity, making it easier to trade without big price jumps. On the other hand, a wider spread suggests there are not as many buyers or sellers, and the price might move a lot with even small trades. Another key aspect to consider when analyzing charts is the formation of different chart patterns, as these can give you insights into the direction of the market. Chart patterns are shapes or formations that appear on the price charts and can often predict future movements. Let us go over some more of these patterns in greater detail. One well-known pattern is the cup and handle pattern. This pattern forms when the price makes a rounded bottom resembling a cup, followed by a small downward consolidation, which forms the handle. This pattern is typically a bullish continuation pattern, meaning that once the handle is completed, the price is likely to break out upwards. Recognizing a cup and handle pattern can give you a chance to enter before a major upward move. Next, let us talk about the inverse head and shoulders pattern. This is similar to the standard head and shoulders, but forms upside down. It signals a reversal from a downtrend to an uptrend. The pattern starts with a low, which forms the left shoulder, followed by an even lower point, which forms the head, and then another low at roughly the same level as the left shoulder, forming the right shoulder. When the price breaks above the neckline, which connects the two shoulders, it can be a sign that a major reversal is underway. Another significant chart pattern is the falling or rising channel. A falling channel forms when the price is making lower highs and lower lows, confined within two parallel lines. A breakout above the upper line could signal a bullish reversal. Conversely, a rising channel is characterized by higher highs and higher lows, and a breakout below the lower line could indicate a bearish reversal. Channels help traders identify possible points for entry or exit depending on whether the price breaks out or remains within the channel. The bullish engulfing pattern is a candlestick pattern that can also be helpful when analyzing charts. It occurs when a smaller bearish candle is followed by a larger bullish candle that completely engulfs the previous one. This pattern suggests a potential reversal to the upside, especially when it occurs after a significant downtrend. Similarly, a bearish engulfing pattern occurs when a small bullish candle is engulfed by a larger bearish candle, indicating a potential downside reversal. We also have rounding tops and bottoms. A rounding top is formed when the price gradually rises to a peak and then gradually declines, forming a shape that looks like an upside-down bowl. This pattern usually signals a reversal from an uptrend to a downtrend. A rounding bottom, on the other hand, forms when the price gradually falls to a low point and then slowly rises, resembling a bowl shape. This is typically a bullish reversal pattern, indicating that the price may rise after forming the bottom. Another chart pattern that is useful to understand is the rectangle pattern. A rectangle forms when the price moves between parallel support and resistance levels multiple times, creating a box-like shape. This indicates a period of consolidation where neither buyers nor sellers are in control. A breakout above or below the rectangle signals that the market is picking a direction, and traders often look for these breakouts as opportunities to enter a trade. By expanding your knowledge of these various chart patterns, you will be better equipped to combine the insights gained from the order book with your understanding of technical analysis. Chart patterns are powerful tools that reveal market psychology, showing the ongoing struggle between buyers and sellers. When combined with other indicators, these patterns can give you an extra edge in determining where the market might go next. Another key concept is market depth. Market depth refers to how many buy and sell orders are available at different price levels. If the order book has a lot of orders, it means there is more market depth. This usually makes the stock more stable. With fewer orders, we call that a shallow market, and it means the price might move quickly when someone buys or sells. Understanding this can give you a good sense of how stable a stock is likely to be when you are thinking of making a trade. The order book is made up of different types of orders, which is another thing that can be good to know. One type is called a limit order. When someone places a limit order, they specify the price at which they want to buy or sell. Limit orders are useful because they allow you to control exactly how much you are paying or getting for a trade. The other type is called a market order. This type of order is executed immediately at the best available price, which means it might go through faster, but you do not have as much control over the price. Now, how does all this come together to form the order book and help traders? At the center of the order book are what we call the best bid and the best ask. The best bid is the highest price that a buyer is willing to pay for the stock, while the best ask is the lowest price that a seller is willing to accept. Together, these prices set the current market price for the stock. You will also see next to each price how many shares are available to buy or sell. This is important because larger quantities can indicate strong levels of support or resistance, which means the price might struggle to move past these points. Moreover, understanding chart patterns alongside the order book can give you an even clearer picture of potential price movements. Chart patterns often align with levels of support and resistance, reinforcing what you see in the order book. For instance, when a stock is experiencing a significant level of resistance, you might notice a double top pattern forming, indicating a potential reversal. Similarly, if the price is struggling to break below a support level, you may observe a double bottom or even a bullish engulfing pattern, suggesting a rebound is likely. Integrating this knowledge with what you see in the order book allows you to make more informed decisions. For example, if there is a large number of buy orders at a certain price level, and you also notice a falling wedge pattern starting to break out upwards, it is likely a strong indication that the price could move higher. On the other hand, if there is significant resistance shown by a large number of sell orders, and you also see a head and shoulders pattern forming, it is a sign that the price may be due for a drop. By combining these chart patterns with the information from the order book, you can identify stronger entry and exit points for your trades. The visual cues from the chart patterns and the quantitative data from the order book work together to give you a more comprehensive view of the market dynamics, allowing you to spot opportunities and avoid potential pitfalls with greater accuracy. By watching the orders coming into the order book, you can get a sense of what the market is thinking. For instance, if you see a lot of buy orders coming in, it could mean that demand for the stock is rising and the price could move up. On the other hand, if you see a lot of sell orders coming in, it might mean the price is about to drop. This is a powerful tool for understanding what is going on in real time. The order book can help you make better trading decisions by showing you potential support and resistance levels. For example, if you see a lot of buy orders sitting at a certain price, that price might act as support, keeping the price from dropping much lower. The same thing happens with large sell orders, which can create resistance and keep the price from going much higher. Using this information can help you plan your trades more effectively. You can also use the order book to get a sense of market sentiment. If you see buyers dominating the book, it can be a sign that people are feeling positive and that the stock price might go up. On the other hand, if you see sellers piling up, it could mean that people are feeling nervous and the price might drop. Timing your trades can also become a lot more precise by watching how quickly orders are getting filled or canceled. If you notice that orders start disappearing quickly, it might mean a price change is coming, and you can adjust your trade accordingly. Something else you might notice in the order book is an imbalance. This happens when there are many more buy orders than sell orders, or the other way around. An imbalance can tell you a lot about which way the market might move. If there are many more buy orders than sell orders, it is a sign that demand is stronger than supply, and the price could be about to rise. If there are more sell orders, it means there is more pressure pushing the price down. It is also important to be aware that sometimes the order book can be manipulated. One common tactic is called spoofing. This is when traders place big orders that they do not actually intend to fill. These orders are placed just to create a false sense of demand or supply. The goal is to trick other traders into thinking there is more interest in the stock than there really is. A good way to spot this is by watching for large orders that appear and then disappear quickly. This can be a sign of manipulation. To avoid falling for these false signals, it is helpful to combine what you see in the order book with other indicators like the trading volume and price movement. Using the order book with other indicators is a really good way to confirm your trade ideas. For instance, you could look at the trading volume. This tells you whether the buy or sell interest you see in the order book is actually leading to real trading activity. High volume can confirm that the price is likely to move in the direction you think it will. You can also use technical indicators like moving averages or something called the relative strength index. For example, if the order book shows strong buy support and the relative strength index shows that the stock is oversold, it might be a good buying opportunity. I also want to share some practical tips for using the order book. One of the most helpful things to do is focus on key price levels. Pay attention to the best bid and best ask, as well as the large orders just above or below the current price. These can give you clues about where the market might be heading. Also, watch for rapid changes. If you notice a large order disappearing suddenly or a spike in new orders, it could mean the market is about to move. This kind of insight can be especially useful for people who are trading in the short term and need to make quick decisions. There are some common mistakes that people make when reading the order book, and it is important to avoid them. One mistake is overreacting to small changes. It is easy to jump in and make a trade every time you see a shift in the book, but it is often better to wait for some kind of confirmation. This is especially true in markets that can be volatile. Another mistake is focusing only on the large orders. While these can show key levels of interest, the smaller, faster-moving orders can also tell you a lot about where the stock might be headed in the very short term. Another mistake that traders often make is misinterpreting chart patterns when used alongside the order book. For instance, seeing a head and shoulders pattern without considering the broader context, such as volume or other indicators, can lead to premature decisions. It is important to consider multiple factors before concluding that a trend is about to reverse. Likewise, wedge patterns or triangles can give false signals if not confirmed by additional market data. Relying solely on the chart patterns without integrating them with the actual order book data, like current buy and sell orders, can lead to misunderstandings about market direction. Another pitfall is neglecting to recognize the psychological aspect of chart patterns. Many patterns, like double tops or flags, reflect traders' psychology, such as fear or greed, which often drives market movement. Ignoring this emotional element means you may miss why certain levels are being tested repeatedly. The order book can show you where traders are feeling confident or uncertain, which adds depth to what you see in the charts. Lastly, remember that the broader market context is always important. News, economic trends, and other factors can have a huge impact on how the order book behaves, so keep that in mind as you make decisions. For example, a large sell order appearing right after negative news might be more significant than it would otherwise be. Therefore, it is crucial to always connect what you see in the charts and the order book with real-world events and overall market sentiment. If you are just getting started with reading the order book, it is a good idea to practice without risking real money. One way to do this is by using a demo account. This lets you place trades using pretend money, and you can test your skills at reading the order book without the risk. Track how your trades go and note what you saw in the order book before you made your decision. This will help you spot patterns over time and get better at using the information. You can also try reading the order book for different types of stocks. For instance, compare a high-volume, large company stock to a smaller company that is less actively traded. You will see some interesting differences in how the order flow looks. Let us take a moment to recap what we have talked about so far. The order book is a real-time window into the stock market that shows the current buy and sell interest at different price levels. The bid-ask spread, market depth, and order imbalances are all key things to understand when you are using the order book to trade. By keeping an eye on these elements, you can make better decisions about where the market might be headed. Watch for large orders, track the best bid and best ask, and use other indicators to get a complete picture of the market. Reading the order book can give you an edge when it comes to making smart trading decisions. It lets you see what is happening behind the scenes, which can be really valuable when you are trying to time your trades. Keep practicing and paying attention to how the orders are moving, and you will get better and better at using this tool to improve your trading.